This video presentation provides insight into Phillips 66's strategic decision to split from ConocoPhillips. The content has been developed by Jeff Anderson, Brian Callaway, and Lund. In 2012, ConocoPhillips split from a major, vertically integrated oil corporation into two smaller and more focused companies. ConocoPhillips became responsible for the upstream exploration and production assets, while Phillips 66 took over the midstream, downstream, and chemicals assets.
Social trends are a key factor in analyzing the current and projected demand for energy across the globe. Population growth is a social trend that acts as a driving force for increasing energy demand. For example, according to the U.S. Energy Information Administration, total world energy consumption will increase 56% over 30 years, as shown in the graph on the left. This is largely credited to expanding populations and economic growth globally. Recent economic trends in the oil and gas industry include smaller companies that allow for specialized investment opportunities, partnerships, larger shareholder payouts that present attractive shareholder agreements, and finally, decreased domestic cost by means of evolved extraction methods that result in higher yields. Political trends are constantly changing, requiring oil and gas companies to conform. Hydraulic fracturing is often banned for its unconventional methods and the results of those methods. For example, Colorado, New York, New Mexico, and Hawaii have either banned fracking across the state or there are city and county bans already in place. Also, emissions are monitored closely by state and federal regulations and are always under heavy scrutiny to improve. Finally, high tax rates and the lack of tax breaks, particularly for refining, cost oil and gas companies billions of dollars each year.
Another component of the environmental analysis includes predicting the technological trends that will occur in the midstream, chemicals, and refining industries. For example, this 2013 map of U.S. shale plays demonstrates the need for integrated transportation systems and additional midstream assets throughout the country. The synergy of horizontal drilling and hydraulic fracturing has created significant growth opportunities in the midstream sector. Analysts anticipate that more than $20 billion per year will be spent on midstream infrastructure up through 2030. In the chemicals industry, the speed of innovation is a critical driver. High-throughput research tools like Envenus's Pro 2 allow for companies to quickly model and explore effective solutions. Additionally, the ability to develop a global organization with standardized workstations and practices encourages employees to collaborate effectively with experts across the world. In the chemicals industry, timing is critical, and being the first company to offer a reliable and desirable product can change the outlook for others. In the refining industry, the gasoline demand across the U.S. and Western Europe has been decreasing since the 2008 recession. Similarly, this graph from the International Energy Agency demonstrates that the dollar refinery margin per barrel of crude is decreasing. As a result of this change, oil and gas corporations are closing their smaller refineries and only investing in the larger and higher producing ones. Analysts anticipate that this trend will continue and that 1 in 5 refining assets will leave the market over the next 5 years. Market competition is a critical driver of performance and innovation, and it also helps keep prices low for consumers. Horizontally integrated competitors include Valero and Marathon Oil, while vertically integrated competitors include ExxonMobil, Royal Dutch Shell, British Petroleum, and Chevron. Phillips 66 hopes that their decision to spin off will allow them to consider specific assets that they would like to invest their time and resources in. They can use partnerships to explore any gaps or growth areas.
A resource analysis was completed on Phillips 66. Firstly, looking at some of the strengths of the new company, Phillips 66 will no longer be burdened with internal competition from the upstream business unit. The company is led by a qualified executive team that has previous experience working together and with the assets. CP Chem, a 50-50 joint venture with Chevron, this business unit is global and differentiates Phillips 66 from its competitors. Phillips 66 has been a trusted American brand since the first service station opened in 1927. Some of the weaknesses after the split: Phillips 66 will be without the financial support of the upstream business unit during unprofitable years. The company will be taking on $8 billion in debt at the time of the split, and with more fuel-efficient cars, gasoline consumption is projected to decline in OECD countries. Phillips 66 refineries are aging and have the added cost of upkeep and modernization. Some opportunities the new company may capitalize on are taking advantage of the cheap domestic crude that can be bought at a discount than sold at world market prices. Increased U.S. production translates into more oil being moved by pipeline, rail, and tanker. As new shale oil plays continue to emerge, new opportunities exist as a first mover. Large projected cash flow to pursue growth opportunities and pay down debt. Threats that may exist are weak world markets affecting commodity prices and investor appetite, retaining qualified staff and management in an increasingly competitive employment market, increased regulatory pressure in areas such as environmental legislation, pipeline specs, and product specs, global climate uncertainty that can result in an unforeseen facility shutdown and damage.
Decisions in the oil and gas industry are driven by several assumptions and criteria. Some assumptions are that the price of crude oil changes with time, the demand for this commodity product is not constant, oil and gas will be the primary source of energy across the globe, and that the market is very volatile. Several criteria are that all oil and gas companies must comply with government regulations, energy consumers will always be present on a global scale, crude oil will always be available, and that new technology will constantly improve the midstream, chemicals, and refining processes. Our group developed the following mission statement for the new Phillips 66. To provide quality and safety-minded energy consumers with fuel for transportation, gas for power, and petrochemicals for manufactured goods through the collaborative efforts of the company's diverse businesses, which include midstream, chemicals, refining, and marketing and specialties assets. In order to achieve this mission statement, we have developed two objectives for the new Phillips 66. The first objective is to make informed investment decisions based on the newest available technology. The first goal for this objective is to expand midstream business units by developing an integrated rail transportation system targeting recently accessible tight oil plays throughout the U.S. A second goal is to make downstream resources and funds available for the company's most profitable refineries within the first 5 years following the split by decommissioning or selling underperforming refineries. The final goal for this objective is to expand Phillips 66's chemical and clean products capacity by 30% by the year 2017. Phillips 66's second objective is to use existing cash flow to create a dividend-paying company that is attractive to its investors. One goal is to demonstrate certainty about Phillips 66's financial well-being by paying a dividend to shareholders within the first year after the split. A second goal is to increase the value of Phillips 66's shares by funding a share buyback program after the first quarter. A final goal for this objective is to reduce the effects of cyclical downturns and keep future investment options open by paying off existing debt when cash is available within the first year after the split.
Phillips 66 strategy moving forward will include: number 1, expanding the transportation network by building rail cars, unit train crude unloading facilities, and utilizing tankers to increase access to advantaged crude. $1.6 billion will be invested in 2013 to accomplish this goal. Number 2, restricting refinery investment to sustaining current operations and is projected at $1.2 billion in 2013. Refineries will be expected to optimize operations, and this will allow management to assess which refineries are profitable and which are not. Number 3, expanding chemical capacity will be accomplished by investing $500 million in 2013. These funds will be used to continue existing projects, expanding current facilities, and move towards approval of the CP Chem's U.S. Gulf Coast Petrochemicals project. Phillips 66 will use existing cash flow to create a company attractive to investors. Current planning has a dividend paid twice a year, a share buyback program exercised once a year, and debt repayment planned twice a year. Assessment of the company's operational cash flow will be done on a quarterly basis. These programs will be performed when cash flow is at a level where there is excess capital to be distributed. The size and frequency of each payment are difficult to estimate looking forward. The quarterly review is needed to know what is feasible.
Phillips 66 long-term plan will focus on areas of growth in midstream, chemicals, refining, and marketing. Midstream growth will focus in efficient methods of transportation by rail, pipelines, ships, and refinery storage. Chemicals growth will focus in new technologies. Refining will focus in obtaining advantaged crudes that produce more at less cost. Therefore, refining surplus will result in increased exports. Finally, marketing will focus on retail locations and new lubricant products. Phillips 66 will focus on future investments in transportation, including negotiations and partnerships with existing pipeline companies and third-party logistics companies, as well as further development in CP Chem and the development of a $5 billion chemical plant to be opened in 2017. Phillips 66 will also focus on shareholders, increasing returns, repurchasing common stock, and reducing debt.
We have developed several checkpoints in order to meet our goals and objectives. At each checkpoint, we plan to compare current financial performance to both industry leaders and Phillips 66's past. Each checkpoint will have a primary focus as specified on this slide. As time progresses, the checkpoints will occur less frequently. After all checkpoints have been completed and 5 years have passed, Phillips 66 will perform its first appraisal of results. During this appraisal, Phillips 66 will confirm that projects have been initiated to meet their specified objectives. They will assess the company's financial stability and compare their progress to competitors and past performance. They will investigate whether or not the company was able to work within the budget they specified for the split and meet all predetermined deadlines. Finally, they will evaluate employee morale and patch up any areas that are suffering from lost talent. Thank you for listening, and we look forward to your feedback.